over 1/3 of all millionaires in the United States consider themselves to be middle class. And as a financial advisor for over 20 years, that really doesn't surprise me. And the reason it doesn't surprise me is many of these millionaires got there by living below their means and by living a middle class lifestyle. In fact, I think it's key to becoming a millionaire. And in today's video, I'm going to share with you the 4 ways people become millionaires in the United States typically, and what we can all learn from it. So let's go for a walk. So there's basically 4 main ways that people become millionaires. And Thomas Corley wrote a book called Rich Habits, where he talks about these 4 ways. And the last one I'm going to talk about is living the middle class lifestyle. But let's start off with the 4 categories that Corley had identified in his book. And the first of those 4 is what Corley calls a big company ladder climber. So it's somebody that's working for a big, maybe Fortune 500 company. They've been there a long time. They maybe started off at a lower level and have been there a long time, have gotten into positions where they have teams reporting to them and they have responsibilities and they're getting a big salary. And so if those folks have done even just a decent job of saving a part of their big salary, which is not a given, right? Over half of all Americans that make more than $100,000 a year report that they don't save a dime. So even though somebody's making $250,000 or more working for a big company, it's not an automatic that they're going to become millionaires, but it is one of the 4 categories that Thomas Corley identified in his book, Rich Habits. The next category is people that have a high-paying specialty. Specialties maybe like a physician or an attorney, but not just any physician, not just any attorney, but somebody that has a high level of specialty where there's a lot of demand and that work is very valuable. And that's how they become millionaires and probably multi-millionaires. Again, it's not enough to make good money. You also have to spend less than what you earn in order to be able to save. And then the second part of that is it's not just enough to save unless you're really making a ton of money. You also have to invest it. Because if you don't invest your savings, then compounding is likely working against you, right? Warren Buffett calls compounding the 8th wonder of the world. And he's right, it is, as long as you're earning more than inflation. But if you're earning less than inflation, compounding's working against you. Instead of your money working harder for you every year, your money's working less for you every year. So that cozy, warm feeling that you might get keeping your money at the bank and not having to worry about the volatility in the stock market, that cozy feeling comes at a cost. Because most bank accounts, savings account, checking accounts, are not paying more than inflation. CDs, for the most part. There are periods of time where they do pay more than inflation, but usually not much. And for the most part, they pay less than inflation. So again, you have to spend less than what you earn, and then you have to invest that. So that's the second group, is the specialists. The third group is entrepreneurs. And entrepreneurs have been in the news over the last 2-3 decades here in the United States. People have built up enormous fortunes by being entrepreneurs. Famous entrepreneurs would be people like Mark Zuckerberg, Steve Jobs, people that have started companies and have built things, maybe not worth billions of dollars, which is what those examples are, but even millions of dollars, $5 million, $10 million, $20 million, can really move the needle and make a difference in your life and the life of people around you. So that was the third category that Thomas Corley identified in his book, Rich Habits. And then the fourth category, which is why I think 1/3 of all millionaires classify themselves as middle class, is really the millionaire next door, what Corley calls the saver investor. So they've made an average salary, maybe they've made a good salary, not a phenomenal salary, but a good salary. And they've done a good job of saving their money. They've done a good job of not spending it all. and saving it up and investing it. You know, they've avoided many of the mistakes. Again, it's not just enough to invest. It's also important to be able to stay the course for the long period of time. So folks that have been able to spend less than what they earn, they've invested it, and importantly, they've been able to stay the course. They haven't allowed themselves to succumb to the emotional pressures that happen when the stock market drops 20, 30, 40%. Then they've been able to allow their money to keep compounding, and they've avoided what I call being a forced seller in a down market. And there's really two ways that people become forced sellers in a down market. It's either they need the money, maybe they have, debt on a certain business that's bleeding cash flow because the economy went south and they need to pay down some of that debt. They have a need for that cash, or they have a need for the cash just for their living expenses. And if the market's down and you don't have other sources of cash, then you become a forced seller in a down market, unless, for many of us, for all of us, this is not financial advice. I just want to put these things on your radar screen. But if you look at your asset allocation, what percent of your investments are in stocks, equities, public equities, things that are going to see the volatility in the stock market, versus what percent of your portfolio is in stable, secure, high quality, short duration bonds that are going to mature in a couple years, things like that. And the purpose of those bonds, those stable bonds in your portfolio, is to be able to help you weather the storm if the stock market goes down. And it does that by two ways. One is it's not as frightening mentally for you if, let's say your stocks are down 40%, but your bonds have basically held up or maybe gone up in value. Makes it a lot easier to stay the course. The other thing is if you have a cash flow need, it's a lot easier to meet that cash flow need by selling bonds that have not dropped in price in order to meet that cash flow need. So while many people would say, I'm 60% in the stock market, 40% in the bond market, or 30% in the bond market, whatever it is, I think it's healthy to not just know what your percent asset allocation is, but how many years worth of living expenses can these stable, secure bonds last so that you don't become a forced seller in your stocks. So those are the four categories that Corley talks about. And then, just talking about these millionaires next door and how do they do it. I can tell you as a financial advisor, while it might just be a third of all millionaires consider themselves to be middle class, I would say half of the folks that have saved up over $1 million that in my lifetime and being a financial advisor for over 20 years, for sure half of those people have gotten there by just being good savers, as Corley talks about in his book. And at first it can feel sacrificial in order to strive to save 15%, 20% of your salary. And I know that that's a big number and it's inspirational and it's not easy for many of us to do. But I think the days of saving 10% of your salary and being able to retire comfortably, for most of us making close to the median salary in the United States, saving 10% likely is not going to get us where we want to be. I'm not saying it won't, but it's going to be harder. And the reason for that is 2 decades ago, 3 decades ago, people retiring, many of those folks were able to count on a pension, and they could also count on their Social Security not being taxed. So there were 3 legs to the retirement stool, and now, one of those legs is gone for most of us, which is a pension. It's very rare to have a pension. And the Social Security piece is something that, for many of us, Social Security is going to be taxed. Up to 85% of our Social Security can be taxed now. So we've got only 2 legs to this retirement stool, which is Social Security, which now is a partial leg because it's going to be taxed. And then the rest of it is our savings. And so you want to get your savings in as healthy of a place as you can. And if you want to have an idea, how do you compare? That's why I made this video here, which talks about the average retiree's income in the United States. Thanks for watching this video, and I'll see you in there. Bye-bye.